Okay, so following on from the last video, when we're looking at the secondary market, basically trading in the second market is determined by demand and supply for shares. So when we're looking at the demand for shares, we're talking about investors that think, all right, this company is going to make a profit, the share price is going to go up, and they're looking to make a capital gain. So a capital gain is made when you sell your shares at a higher price than what you bought them at. And then basically you've got people supplying shares, and that's people that are investors looking to sell their shares. So generally they'll be selling their shares because they think the price is going to go down, or perhaps they just need the money at that point in time, so they're selling their shares so they can now collect their money and go do something else with it. So if there's more demand for shares than supply, the share prices go up, and vice versa. So two key words when we're looking at the share price. Basically, there's two things you can earn on a share. You can earn a capital gain and you can earn a dividend. So dividends aren't when the share prices go up. It's basically just when companies make profits. What they can do is they can give their shareholders a certain amount of money, basically just as a reward for that company making a profit. So they give the company, all their shareholders a dividend as basically like a reward for being a shareholder in that company, and you might get, say, 10 cents dividend per share or something like that. Capital gains occur when your share price increases in value. So if you buy a share for $20 and it sells for $30, you make a capital gain of $10 per share. So if you've got 1,000 shares, you'll make $10,000. So capital gains is when you make money because your share price increases. Dividends is just basically a payment that the share company can give you because they're making a profit at that point in time. A stockbroker is the other key term. A stockbroker is somebody that buys and sells shares on the stock exchange. So the person that basically is the middleman between you getting a share is what we call the stockbroker. So their job is to try and get people to buy shares, and they will earn a commission or a little bit of money every time somebody buys a share in a company. So it's their job to try and get people to buy shares in companies, and they'll make a little commission every time they do so. Some other facts about the Australian Stock Exchange, and I apologise for having so much writing on this slide, but there are over 2,200 companies listed on the ASX. So there's 2,200 public companies that are listed on the Australian Stock Exchange. These companies are divided into different sectors, so you've got basically different companies within the banking sector and insurance and real estate and so on and so forth. You don't need to worry about that too much. A company can raise money to grow its business by going public. So companies will issue shares to investors, then they'll be listed on the Australian Stock Exchange, and then by paying for these shares, each investor becomes a part owner in that company. They are a shareholder, and therefore they own part of that particular company. After the shares have been issued, they can then be sold to other investors on the share market. So in this way, a shareholder can potentially make a profit by selling their shares for more than what they paid for them. So when you sell your shares, you're just selling them to another shareholder. You buy or sell shares by using a stockbroker. Stockbrokers buy and sell shares in the market on behalf of investors, and you pay a brokerage fee every time the stockbroker buys or sells shares for you. And so when they sell shares on the client's behalf, they receive a brokerage fee. Share trading takes place between 10 a.m. and 4 p.m. every day, so you can only trade stocks between 10 a.m. and 4 p.m. That's when the stock exchange is open every single day. And finally, just looking at some factors that can increase and decrease the demand for shares. So basically, what you need to think about is the demand for shares will increase when more people want to invest in companies because they think companies are going to make money. So if consumers are confident, they generally spend more money, and therefore share prices go up because people are spending and their companies are making higher profits. When there's increased overseas growth, what that does is it helps our Australian companies make money because companies overseas or people overseas are more likely to buy Australian products. So for example, if China's growing faster, there might be more people coming here on holidays or getting education in Australia. Chinese companies might buy more of Australia's minerals like our iron ore and our coal for infrastructure. So overseas growth being strong is really good for the Australian share market. Low interest rates is really good for a couple of reasons. When interest rates are low on savings, it means you're getting a lower return for putting money in the bank, so you're more likely to buy shares. So when interest rates are low on savings or term deposits, people would prefer to invest in shares because they're going to generate a higher return. When interest rates are really high on savings, people would prefer to put their money in the bank. So the lower the interest rates, the more the demand there is for shares, because that means that basically you're going to get a better return investing in shares than you would by just keeping your money in the bank. A depreciation of the Australian dollar, that's good because for a lot of companies that are exporting, because then basically foreign currencies will have more purchasing power to buy Australian products. So when the Australian dollar is low, people overseas want to buy Australian products, and therefore companies make more money. So if we're involved in the exporting of tourism, education, any form of mining, all of those companies will benefit when the Australian dollar is low. A couple of other things, if you expect higher profits, if the price of things like gold increase, they become more expensive, so people prefer to buy shares. If any firms make like a technological breakthrough or come up with a new idea, that will increase their share price as well. In terms of decreasing demand, most of these are just the opposite, so reduced consumer confidence, higher interest rates, and appreciation of the dollar because that makes things more expensive for foreigners. Weak overseas growth rates. If you expect the company to make low profits, if it's cheap to buy gold, people will buy gold instead of putting their money in shares. Or if some like high quality CEO retires, then people might think the company will make less money and the share price will go down. Thank you.